Good morning, everybody. First of all, I'm just requesting everybody mute the microphone for a bit. Let me go through some information. I hope you can see my screen at this point. I'm just sharing the TradingView window. Can just one of you please confirm if you can see my screen?
Yes, we can see screen.
Yes, we can see.
Okay, perfect. Thank you. So what the point of this meeting at this point is the market. Obviously, 2022 has been a pretty bad year in terms of any appreciation or growth in the market. So we had 2 or 3 meetings before this, and we discussed just the basics and the volume price analysis, and also we discussed levels, support and resistance. I just felt that the market is trending and is stationed at this point where it's very interesting moving ahead. So one thing, if I ask you a question at this point, are you a proactive trader or a reactive trader? I'm pretty sure 90% of you at this point will say that you are a proactive trader, like you buy a stock, assuming that something will happen. But in the stock market, as far as I've known and spoken to people, just for information, I am a part of the Bear Bull Traders community, which is the author of which is Andrew Aziz. He is Amazon's bestseller in terms of books for traders. So his main point is you cannot be if you want to be a trader, like it's not about it. There's a difference between investing and trading, and both of them have a common philosophy. If you want to be more profitable in that terms, you have to be a reactive trader. You cannot be a proactive trader, because if you're proactive, you're assuming that the market is going to do something that you're anticipating in a way. If you're reactive, it means that you let the market do its thing, because you buy or you don't buy, the market will do its thing. So let the market play out the way it wants to. And it's dependent on a lot of factors. It's dependent on geopolitical scenario, it's dependent on pandemic and many factors. So let it do its thing, and then we can monitor the levels and then buy or sell based on levels. And that's what precisely I'm focusing on today, just the levels. And we have two basic concepts in stock market investing: support and resistance. Support is basically when let me try to draw something here. So there is support. Sorry. Okay, so there is support and there is resistance. So a stock can fluctuate. It will bounce from a level consistently, and it will appreciate, and it will bounce back down. So this is your resistance. This level won't let the stock go above it, this point, and there is a support in which there is like a ceiling and there is a platform. So those are the two basic concepts of investing, and we are pretty much seeing we saw some bounce on some stocks. We saw some ceiling on some stocks. So let's start with the basic indices. So Dow Jones Industrial Average, which is a combination of 25, or I guess right now it's 30 stocks of the most elite stocks. So you can think about Apple, Intel, Walmart, and all these stocks. They constitute this Dow Jones Industrial Average, and they are coming close to what I see as they actually bounced a little bit. You can see here from this support level here. So it had met this level. See this bounce point? It's a little bit elastic. It's not exactly that point, but you can see back just before the pandemic, it had crashed from that level. And again, there was a resistance here, and then it blew past that. It has to at some point. And right now it's coming back to that same level here. So that resistance is now turning into support, and that's a very nice phenomena that happens in the market. Now, this is not to say that this is it. This is the reversal of the market, but The point is, and the point of this meeting exactly is, that we are seeing the markets at these levels at this point. This is exactly in the pre-pandemic level. So is this a buy signal? We can wait for just one more week and see how the market behaves at this level. If it falls further, we have the time, we have the luxury to wait. If it does not, if it bounces and there is a strong bounce, and probably it's like for a long-term buy signal. So these are the levels we're talking about. And there is a very, very kind of a mystical factor here, because we don't know what's happening. The market, the big bankers, they are controlling this. They are pumping in the money. There is something happening. All we can see from our side is these levels. It's bouncing from a level. So if we have this information, and keep in mind, not many people have this information, they either just buy for the long term, or they just buy blindly for short term, hoping that the market goes up. So having this information, as retail investors or retail traders, we can wait now for a few days and see how the market behaves. And at the same point, let's take an example of the S&P 500. The S&P 500 is a combination of 500 important stocks. Like it covers like a wide spectrum. It has Amazons, it has Teslas, Microsoft, all these stocks. So many people actually invest in this index, the S&P 500 index. The reason is that it has consistently given like 8 to 10% appreciation, since forever. So this is a very safe form of investment. And let's see how the S&P 500 is behaving. And we can see that it's a little different. It's not exactly like the Dow Jones. So this is a pre-pandemic level right here, just before the market crashed, before the lockdown. So we are at 3,400, and right now it's at 3,580. So what will happen next is something we should not predict. It's not like we cannot, but we should not predict. But what we can do is, based on this level, we can take some very calculated decisions. I strongly feel that we are heading into a very, very interesting one month, I believe, where it could signal if it is a reversal or if it's going to continue with this depreciation. But one thing, just a general note, is if you look at the depreciation that happened in the last 9 to 10 months, since last November, I believe, this was a market top last November. Everybody was saying that, just invest, you're going to get your money very quickly, but it depreciated from here. So if I just see how much it depreciated since last November, around 28% was a depreciation. And so in short, if your portfolios in this year has been down about 30%, which is close to the depreciation of the S&P index, then it's okay. Don't panic too much. Many people have, gone through a very bad time in the last 1 year, and we'll go through all the factors why it happened. So I'm just saying that if you have experienced like a 30 or maybe even a 40% depreciation in your portfolio, it's okay. It's not your fault. It's because the market has corrected. The interest rates have gone up. The inflation has been crazy. And finally, there is one more factor to this. Two more factors. One is the supply chain disruption because of the Russia-Ukraine war. And finally, there is a labor shortage, which always was the case since 2 years, since the pandemic, this thing. So 30 to 40% depreciation in your portfolio, do not actually worry about. I'm talking about the overall depreciation. If it is around 30, 40%, or if it is less than that, you're done better. But if it is like 30%, you are in many people's boat at this point. But if your portfolio has seen like a 80, 90% depreciation in general, that's a big reason to worry. But having said that, if you have like 10 stocks and 2 stocks have performed okay, but 2 stocks have gone down like 80, 90%, it's fine, because there have been examples like DocuSign, Netflix, and PayPal, and even some high-flying, before the pandemic, high-flying stocks like Beyond Meat. These have gone down. Peloton, one more example. These have gone down 90% from their highs. So if that has happened like 1 or 2 instances in your portfolio, that's still okay, I believe, because everybody does that mistake. DocuSign, nobody believed that it's going to go down so drastically. It has gone down 60 to 70% from its highs. Netflix from $700. If you see Netflix at this point, it's $230. So if you look at the overall depreciation of Netflix from its highs, it has gone to a whopping 75% down. And this was supposed to be like an elite FANG stock. Nobody imagined this. It's lower subscriber growth. They're losing money. They are laying off people. So just to break down this analysis, why did this happen this year in the market? First thing is, we can just point at inflation, but what is inflation? Everybody knows, but why did inflation rise up 8% this year? The reason, for that is we had the pandemic, right? And everybody were in a lockdown. Many people lost their jobs, unfortunately. So at this point, just to stimulate the economy, to keep things going, the government, the Fed, actually started pumping more money, and they started giving it out in terms of stimulus checks, hoping that people will have that money. For people who were unemployed at that point, they have something to fall back on. So they were getting on an average about $2,500 to sustain their livelihood. But other people who were well off at that point, even many people, there wasn't a way to segregate. So everybody got this money pretty much, which was known as stimulus checks. So your original money got diluted because you have more money that's controlling the same amount of supply chain in the market. So you have more money for the same value, which means that the value of your money has gone down. That's a simple concept. But what happened is, because of that, people started spending that stimulus checks to buy things that they otherwise wouldn't have bought. So everybody, got their favorite mountain bikes, they got their favorite cars, and it just propelled a very snowball effect. So once everybody started spending that money on things that they may not want, there was a very high spike in demand. The demand actually rose for items like crazy. So now you have money that you did not anticipate, but you have it. Not many people try to save that. And saving is not the best idea as well. So the demand rose like crazy, and you had items like, mountain bikes, you had all your luxury items, or may not be exactly luxury, but items. And the merchants, they were not able to keep up with that demand. So what they had to do is they had to rise up prices. That was the only way to sustain that. So everything which was costing like $2 now costed $3. Everything that was costing $3 costed $4, and $100 costed $150 or something more. So that is exactly what's happening. That effect is what we're seeing in the market. More demand, less supply, which means that prices go up, so inflation has gone up. The every year appreciation of inflation is 2%. That's very healthy. That needs to happen. But right now it's at 8%. So that is the primary cause of that inflation that took place. That is the first thing. Secondly, the Russia-Ukraine war, everybody knows what happened there. It has disrupted energy supplies, material supplies, and even the regular supply chain. Even the ships that were supposed to come, they had to divert paths. There is no supply of raw materials. So that's a big concern. That's a different thing. And one more thing is the Federal Reserves. They are actually, to control the inflation, they are hiking up the interest rates. And I don't think everybody knows what the effect of interest rates. Very simply stated, what the interest rates, that's a common thing you'll be hearing in the news. The interest rate has gone up. In the pandemic level, it was 0% interest, and now it's about 3.5% interest. So this is a very a complicated theory to understand, but very simply put, you can just assume this as in the pandemic time, when the Fed actually got the interest rate down to 0%. All the companies that were trying to, all the growth companies that needed money, they could get a loan money. They could loan money from banks for almost 0% interest at that point. Maybe there was like 0.07% interest or something, but that was beautiful for those companies. But right now, if they have to loan money, the interest rate has gone up to 3.5%. And what this means for a company, just a company, is that before, suppose this is a company, this is a EV startup, I'll just name it as X. EV startup. In general, a EV startup, as far as my experience goes, they need about 300 million. Like if it is a very aggressive company, they need about 300 million per quarter to go through their operations and sustain their business. So per year, if you can approximate this to maybe $1 billion is what they need to sustain and keep growing and put product out. This is the amount of money they need to loan from a bank. In the pandemic time, if they took this money, they did not have to pay any interest. Right now, they have to pay about 3% interest back on this $1 billion. So imagine this, they're paying like $30 million back in interest to these banks, and they're hardly making any profits because it takes a few years to get the products on the road, have the customers trust and make profits. So they have to constantly keep pulling back and pay this $30 million just in interest, which means their balance sheet will shrink. They have lesser money and they have to cut down on cost. They have to cut down on people. And that's why we're seeing the layoffs. And that is, again, a snowball effect. What it means is that if you have layoffs, people are more skeptical. They are less likely to spend money. And that'll affect in economy, right? Because now you don't have enough money that's being pumped into buying items. So the general economy will shrink. So that is the snowball effect of interest rates. So interest rate will affect us as well. It's not just the banks. It will affect us in terms of economy. And I just explained how. And also, it will affect in terms of your credit card bills. If you forget to pay your credit card bill, you might see a higher interest rate. And that's, again, a snowball effect of the Feds actually hiking up the interest rates. Everything comes into play at one point. So having said that, we went through the reasons why this happened. Nobody could have anticipated that. So that's why I'm saying if you're down like 35% in your portfolio, don't punish yourself. Everybody has gone through this. And even I have my general portfolio is down by that much. And I have a few stocks. I used to own stocks like Peloton and Beyond Meat that have gone down like 80%. But just make sure the key thing is, the very important thing is to make sure that these stocks that have depreciated 90%, which are more of a hype stock, and I can name a few: Beyond Meat, there is Peloton, SoFi Technologies. So this, like these companies are not making great profits. So they are like kind of innovative products, I would say. Beyond Meat is kind of a unicorn product because it's meatless meat. So it's plant-based meat. People have not accepted it yet, so it's very skeptical. Peloton, they are one of a kind. Yes, there are companies that will manufacture like ellipticals and treadmills, but they have a very unique, software-centric business model. So even that is kind of a unicorn stock. So they weren't making much money before, but Peloton is an exception. They were making money, but unfortunately they went down a very wrong path. But the rest, if these have depreciated like 70, 80%, the key thing is if you have stocks like this, which have given you like 80% depreciation, that's okay, as long as it's not a big chunk of your portfolio. If you're investing in skeptical stocks like this, make sure that you don't invest more than 10% of your portfolio, so that when this happens, your loss is still sustainable. It doesn't affect you too much. I know people in our own community here in this investment group who have invested like 70 to 80% of their portfolio in growth stocks, not exactly growth stocks, but hype stocks, assuming that they can retire early. But they're in a very tricky situation right now. I won't say bad, but tricky situation. So if you're trying to do stuff like that, from your non-traditional portfolio, like the Amazons or Microsoft, you're trying to invest in like stuff like Beyond Meat and all this stuff, just make sure it's not more than 10% of your portfolio. I would recommend 5, but if it is 10, based on your conviction, not more than 10. That is a very key thing to observe. So, okay, having said that, what stocks I'm actually tracking at this point? The first thing is obviously Tesla. It's a fan favorite. One of its kind. A few years ago, it was a one of its kind stock because not many electric vehicles were out there, and Tesla just proved their point, and they're right up there being the leader of this industry. So immense growth happened because of that, and everybody has their respect for Elon Musk. But how is Tesla behaving as a stock? Obviously, it had an exponential growth here in 2020 and 2021. But right now, if you see this red dot line, it's coming to, I can see that this is a support, which is 185. But let's see if we have anything before that. We have this as a support right now, where it's sitting as of yesterday, or sorry, the day before on Friday, which is 14th of October. It's actually sitting at a very good support level. But right below it at 180 is another very key support level. But the most interesting thing about this stock at this point is that while it's trading along the support and resistance, its earnings is coming up on the 19th of this month, which is the Wednesday, I believe. Is it Wednesday? Yeah, it's on the Wednesday. Its earnings is coming up. So this is a very important earnings call according to me, because if it comes down to 185 and it's lingering there is a high chance. Now, this is not being proactive, but I've seen stocks do this. You might, there is a high chance the change in the stock's value could be high if it lingers in this level, or it comes down to 185. I'll show you an example. Let's take a look at Peloton. So this is Peloton last October. And just look at what happened here. Support bounced off, came back to that exact support level of $80. This is look at the beauty of the support level here. There is something very mystical happening. As I mentioned, it comes back to that same level, bounces a little bit. And this was their earnings call right here on 3rd of November. And everybody thought that, this is a very strong support level. Peloton is like one of its kind stock. It's going to bounce up. They had a very bad earnings call, and there is no looking back for Peloton. Like, it has been a disaster after that. It's been just trending down. So I'll be very cautious with Tesla as well. Tesla is not Peloton. Tesla is a very accomplished company. But when it's actually sitting on a support level, again, just give it a few days. There is a chance it can rip from here, it can go higher, but it's not a risk you want to take at this point. If you're trying to add Tesla stocks, I would say just wait for a few days, or at least wait for earnings. It's a very risky thing to go through earnings, holding a stock, assuming it's going to go up. It's a very, very bad strategy. Don't do that. So wait to see how it behaves at this 208 level. I guess it has just gone below the 208 level. So there is a chance it can go further down here as well. But if it comes down, wait for this 184 level. Now, many people can say that if you're holding Tesla for long term, just add it, just add it whenever it is down. It's not a great way to add. If you have the education like this, where you can see the levels, these are very, very important, respectful levels. If you can see these levels, just wait and see how it behaves around those levels. If you think that it's a very strong support, which we can confirm next week after the earnings, I believe, then that would be a time to add. But if it depreciates, and if Elon Musk comes out and says that we are stopping production for 6 months or so, it's crazy. But if that happens, then there is a chance it can go further down here. So simple example, if you're trying to invest $10,000 in Tesla at this point, at this level, you'll get like 50 stocks. But if Tesla goes down to even like 185, you're losing $25 a stock. So 50 into 25, you're already losing a lot of money there, which is, $1,300 or something. Why waste that money is my point. Just wait to see how it behaves around those levels. Few other things apart from Tesla. So that is why we had this meeting. It's not like buy this right now or sell this right now. Rather, it's like wait for the confirmation kind of a meeting. So please go to TradingView and analyze your stocks. I'm just analyzing a few stocks, but analyze the stock you are interested in. It could be Amazon, Apple, whatever it is, and see how they're behaving around those levels. And if you have any questions, I'll be more than happy to answer how the support and resistance is. But this is a free platform. Enter your stock like Amazon, You can enter that and see how it's behaving. You can just zoom out and you see that even Amazon, right, it's coming. This is a very important support level here. And Amazon is coming very close to that, which is $100. And see what happened just 1 month ago. It had a bounce from $100. And why did it bounce? If you just trace back a little bit, it had this ceiling back in 2018. That is a level that, the big bankers respected. And one more very key thing, I don't know if you observed this, is when it comes down, when it comes to that level, look at the volume here. Look at the volume around when it comes to these, support levels. If the volume is high, it means that there are people actually, very interested in this stock. It could be buy or sell, but if there is high volume, it means that there is a lot of traction at that point. Very likely, if it comes down to the support and if the volume is high, it means that the big bankers are buying. So you cannot compete with the big bankers at all. Like, they have the money to move the markets. Me and you, we don't have the money to move the markets, but what we have is this information, and we can buy and sell. This is where we can win, because the big bankers cannot just buy and sell. They have to buy in chunks and they have to sell in chunks. But we can buy 10 stocks of Amazon and sell it like in the next second. We can do that. They don't have that luxury. They have to buy like in millions here and then sell a few thousand. That's how they have to do it. But we can buy and sell, and we can go for a ride with this. So Amazon, are you going to buy? Again, my suggestion, it's earnings week in a couple of weeks. So just wait to see how it behaves. This is a beautiful level for Amazon as well. And I'm very sure if, it might bounce from here, but if it does not, then the next level you have to see in Amazon is something here. So keep an eye on these levels. Don't just, if you're planning to buy, just hold on these Amazons and Teslas. One more I want to look at is Apple. Apple did not depreciate too much because, they had the sales forecast was high. They did not have any supply chain issues per se, even though China was shut down a little bit. They didn't have much issues going on, and they have very solid cash in hand. So Apple is sitting pretty as compared to many other stocks. But the levels for Apple, this is again, respected here, almost respected here, respects here. Here, not exactly, but as I mentioned, it's kind of an elastic level. You have to see how it performs around that support. And now it's on the verge of, going down or up at this point. So even Apple is sitting at a very, so it's not just the Dow Jones Industrial Average, it's in general. You have to see which stock is, it's dependent on the market. These are very highly dependent on the markets, because actually markets don't control this, or like the indices. I mean, the Dow Jones or S&P don't control it, but stocks like Amazon, Apple, Tesla, they actually control the S&P for a large chunk, because they are such giants in this markets, right? So having said that, I wouldn't have like very different recommendations in terms of stocks, because if you have stocks like Amazon, Microsoft, Tesla, Apple that are on discounts, why look beyond those stocks? One more thing I would like to add is NVIDIA. This stock is having issues of its own. This is supply chain. This is China sales that's being affected. And of course, a lot of things with semiconductor stocks that have gone bad. So it has gone from a high of 350. So if you trace back at the depreciation of NVIDIA, oops. So that's a 70% depreciation on NVIDIA. If you look at levels, NVIDIA is, again, lingering around that support level. So if it does not respect this level, and if it falls further, then it would be interesting, because the next level, as I see, important level is around 77. So very interesting to see how NVIDIA behaves at this point. So these are like the stocks I'm keeping track of: Salesforce, NVIDIA, Amazon, Apple, Microsoft, Tesla, Nucor Corporation, Netflix. I have not bought Netflix stock yet, because I don't think this company will go bankrupt in anytime soon. but I'm very interested to see if, if these levels hold up, and how this earnings call again plays out on the 18th. And depending on that, I might see if I can, try to add some Netflix stocks and make some profit out of it. I'm not sure about like the ultra long-term growth of this stock. It may or may not happen, but in the short term, in the next 2-3 years, I don't think Netflix is going bankrupt. So it'll be interesting, at least in terms of a swing trade perspective, to see how Netflix acts. So please look at TradingView, your support levels. We are finishing in 5 minutes. I can probably just take like 2 or 3 questions because we just have 5 minutes in this meeting left. I already have a question on the chat window. Let me answer that first. So the question is, how are you marking or getting those support and resistance level? What's the easiest way to display instead of drawing lines and stuff? I use Webull, RH, and Fidelity. I know Webull's graphing is good, but trying to see how I can draw those support and resistance level along with trend line for day trading and weekly options. So I don't see your name on here, but I have Interactive Brokers, I have E-Trade and Robinhood. But considering Interactive Brokers as one of the best brokers, even then I would highly recommend TradingView. This is a free platform, and you have the tools here. And this is just a vertical line tool here, what I have. And you can zoom out and in very easily. It's very user-friendly compared to any other brokerage account. This is not a brokerage account. This is just a tool for your stocks. You can have scanners and you can have these stocks, and just click on this line and see where the support is, and just click there. It's going to give you a line. If you want a trend line, you can draw stuff like this. So this is how I'm seeing this. This is a TradingView platform, and let me attach a link. I have no affiliation to this. It's a free platform, so please use this. I have used this